bonds, what is the kind of spread trades that bond traders would do? And it's actually a really easy question to answer. And this is just signified by sigma, for example. This is sigma. And the idea of this, of course, is this shows me the spread. This very clearly shows me the spread. And it shows me clearly what I should be doing with the spread. So if I'm going to be spreading this as a bank institutional trader, I'm going to be selling the spread here. I'm going to be selling the spread here. I'm going to be selling the spread when I see these spikes in blue colors. If it's up, I'm going to be selling it. If it's down, I'm going to be buying it. I'm going to be selling the spread. So you can see there's lots of opportunities for me to sell the spread. Loads of opportunities, even on a 5-minute chart, for me to sell the spread. And likewise, there's plenty of opportunities for me to buy the spread going forward as well here. So you can see that there are plenty of opportunities for me to come in on the buy side of the spread in these areas here. The bigger the spread, the better. The bigger the sigma, the better, of course. And obviously, this is a very, very standard institutional type spread. You can see it's obviously a market that looks very uniform. You can see it's very, very clearly a market that can be spread. And when we look at the market, we can see that if I sell every time we get those high prices and I buy every time we get those low prices, I might not make very much, but I'll make it very, very consistently. So when we look at that as a trade outcome, we can see, for example, here. So if I buy the spread here, I'm a buyer of that level there. If I'm a seller of the spread here, you can see where I'm a seller, right? So you can see that's a nice little bit of profit there. If I sell the spreads there, that's a nice bit of profit. If I sell the spreads there, that's a nice bit of profit. If I buy the spreads on these downticks, of course, I undergo a little bit of drawdown in this phase here. So you can see, but you can see that the spread is very small, you know, so obviously you factor that into your account as well. The bigger the spread, the bigger the size you put on the deal. A small spread sell there, that's okay. That works out really nicely. A very large spread buy trade comes in here. We take a very, very easy win off of that one as well. A small buy trade comes in here just before the data comes out. And then, of course, on the spike on the data, a sell spread comes in just here, and we're able to make a little bit of money on that sell spread. So spread trading for an institution is a little bit different because you're using potentially hundreds of millions of dollars on one single spread, assuming the market's big enough to compensate you for the size that you're going to be getting in terms of outcomes. But the other thing we understand about this is if we understand spread trading, maybe there's something else that might be tradable behind that spread. And that's where we make the breakthrough as floor traders. You start thinking like a spreader, but you don't take the spread, but you know what the spread is. Well, if this spread always seems to make money, I should be able to look at that and say, well, if that spread always makes money, how am I going to be able to use that to find possible trades? How am I going to be able to use that to find a possible play in any of these locations? And I can try and see whether I can get a bit of value from that. So when I look at this today, for example, and I look at this and say, well, can I get any value for this as a trade here? I should be able to look at that and say, well, if this is a negative correlation, I should be able to get value by buying, for example, bonds here. And obviously you can see that you would maybe have been able to get a bit of business. I could look at this spread here and say I should be able to make money selling bonds. And this is coming into the close, so it's not ideal. Coming into today's market, of course, I'm looking at spreads. I could have sold here, so I could have bought bonds here. And if I bought bonds at a very high price there, I still would have been able to make some money. So knowing what the spread is going to do, knowing what the bank is going to do with a spread, if I bought the spread here, I would be able to sell bonds 3 o'clock. Well, that short on bonds looked pretty good, did it not? So we obviously can understand that that sell on bonds would have given us that spike to the downside. This spread looks as if it's tradable coming back in again, so we're obviously aware of that. And the more spread we get, the more tradable a low price becomes, and we start looking to buy back into that bond position, for example, in there or in one of these downticks here. When you think about the spreads that you can do, and you think like a spreader, some trades actually become quite an interesting proposition at that stage. And bearing in mind, we could trade this on the oil prices, we could trade this on the equity prices, or we could trade this on the bond prices, or a combination of any of them. So we get a feeling about what we should be doing on any of these plays using the process of a spreader, but not necessarily doing the spread. Think like a spreader, trades become visible. We'll be touching on that in classroom again today, because I wanted to look at this trade here. And again, it's you could use 2 sigma to try and understand some of that spread narrative. Have I got a 2 sigma idea coming onto the screens or not? And obviously, it's up to you whether you use things like sigma or whether you simply eyeball it as an exercise. Well, I look at this spread here. This is a spread that we could look at this afternoon. And when I look at this spread, I'm not interested in this here. I'm interested in the relationship between this. You can see this looks like an arbitrage. You know, when it drops, this drops. When it rallies, this rallies. When it drops, this drops. When it rallies, it rallies. So if we understand that that is a good-looking arbitrageable type event, one of the things I can look for is when they don't line up, of course, and it happens just there. You can see this actually goes up and this goes down to a brand new low sweep. As a spreader, this would make perfect sense now, wouldn't it? Because as a spreader, you would buy this product and you would sell this product here. Well, whether you do that as a spreader or not doesn't actually mean anything. What means something is the fact that you're now thinking about what that is as a spread. And obviously, as a spread, I can now look at that and I know that that spread allows me to do what? Well, that allows me to sell the S&P. That spread there allows me to go short the S&P. 1456. Okay, so again, it's coming into that data release. But at 1456, if I can sell the S&P at 1456, that's the trade that was coming in here, right? That's the trade that was coming in for that short sell. The delta's getting punched up and I'm looking for that short sell on the spread. Remember, I was saying to Sammy about why some reasons why you would take a deal, perhaps even coming into a data release. So when you see that there was a reason to take that S&P short because of the spread narratives, well, you might have been able to be a little bit more comfortable about taking that extra risk on your books at that point. And obviously that idea seems to hold true, because as a spreader, one of the things you'll probably already be able to recognize just from this chart, from a spreader's point of view, it looks like it's if it's buying the blue line and selling the candles as a short S&P trade, it seems as if the entire market's been short S&P. You know, when you look at these on individual candle basis here, you can obviously zoom in and you start seeing little changes, but you can see, for example, there was a very obvious short sell on the S&P during this phase. As this made a new lower low, this was miles away. So you're looking at that and saying, if I can't get short the S&P here at 1509, 1510, I would be surprised. 1509, 1510, there's 1509, 1510 coming in here, right? So what are you starting to see? You're starting to see the opportunity to get short, thinking like a spreader. It's an exhaustion print into a high price. So maybe you're worried about that, but perhaps you're simply looking at it from the point of view of, well, I'm into a high price. I'm taking the exhaustion print. Let's get the trade off. And when we see the trade coming in, we can see, for example, there's a buyer coming in here and the price comes down, allowing you to maybe go for that press. And that might have been a trade you could have taken based on that storyline. So when you think about your markets as a spreader, the way that Charlie D did, you suddenly think of the spreads that should be very, very highly correlated, the spreads that make sense, the spreads that show me something that I didn't know before, the spreads that give me confidence to execute. Think like a spreader and you'll start thinking like Charlie D. You'll start seeing the same things as what I'm seeing. You start seeing the same ideas, the same idea that there is a sell coming in here, instead of the fact that it's just an exhaustion. My job here is to try and figure this out. And obviously the idea of trying to figure that out is to take a pop at that and see what happens next as a spreader. And that's as a spreader. Now remember, the key to this is, of course, you've got to have a starting point for your thoughts. You've got to have an idea. You've got to have an idea, A, that it works so that you waste time on it and it's not a waste of time. You spend time on it. you've got to have an idea that it's not just going to be another rabbit hole that takes you nowhere towards a trade. So it's very, very important that we achieve that as well. We make sure that we understand what it is that it's doing. And if we can understand it, we can also use this idea of trying to be in front of the delta at most occasions. And we can see if we're trying to be in front of the delta just now, it's very difficult to be short the S&P. Take a look at the delta just now. It's very difficult to be short the S&P right now, isn't it? The only place we can be short the S&P is what? Higher highs. Higher highs. Higher highs, right? The only place we can be short the S&P is higher highs. So the spread doesn't agree with the stories that we're getting from the delta. So that poses as a real-time problem, which is why I'm chatting just now, because I don't have any great trades just setting up just now. We should be in front of the delta and behind value. If I'm in front of delta, that would mean that I'm bullish. But my value says I should be bearish. So obviously for the moment, I am simply just taking a relax on this at the moment. I'm simply not getting too involved in doing anything. It's a shit market. And if it's a shit market, I'm not going to play it. Pretty simple stuff.